This is the View from Europe panel that is the title of the presentation, although it's maybe more apt to say the views from Europe, because I think one of the wonderful things about Europe is there can often be disagreement within that sort of monolithic continent. What we're going to start off here today, I think, and talk, first of all, just have everyone briefly introduce themselves, and then we'll move into issues which are very particular to Europe, both in terms of perspective on how the global business is developing, but also issues that I would are sort of within Europe issues, and try and give some visibility on those for what is largely a U.S. audience. So if we could start with you, Partel, and just go from right to left and introduce yourselves and take a couple of minutes to talk about your business and where you're from.
Hi, my name is Partel. I'm the CEO and founder of Bondora. Bondora is a near-prime personal lender or marketplace. We service customers in Spain, Finland, and Estonia. And since our inception, we've been able to deliver our investors net yields of 18% per annum. Our range, our target range, is between sort of 15 and 18. And as of a couple of weeks ago, we're likely the first platform in Europe to also accept US-based accredited investors as customers. So who anyone from you sort of fits the sort of criteria, then feel free to join and try it out. I think I'm going to pass.
Good afternoon. I'm Angus Dent. I'm one of the founders, and I'm also the chief executive of a platform called ArchOver. ArchOver facilitates fixed-term lending to companies secured on the borrower's accounts receivable. We put a credit insurance wrapper around those accounts receivable. So far, we've lent about £7 million on that basis. And what we're really about is allowing the borrower to lever on the creditworthiness of their customers, which tends to lower their cost of borrowing, of course, while at the same time building in plenty of security for the lenders and giving them a well above average return.
Stuart Law, CEO and co-founder of Assetz Capital. We're a secured business lender in the UK. Our first $150 million of lending was purely from retail investors, a luxury we have in the UK. Don't have to be accredited. And then we're also partway through the onboarding of about $100 million of institutional funding as well, some of which is contracted, signed up in public, some of which is not visible yet. So we're well funded, and we're just growing the business to offer a range of secured lending products, from secured business loans, commercial mortgages, buy-to-let, through to invoice discounting. We have a JV, for example, with IFG, who are well known in the States, to roll out in Europe. And our average weighted yield for lenders in the last 2.5 years has been about 11% per annum. And the effect on that from expected losses, because expected losses are more important to a secured lender than defaults, is an effect of about negative 0.4% per annum on that return. And that's what we're doing. About 50, 60 people.
My name's Nicola Horlick, and I'm the co-founder and CEO of Money&Co, which is another UK lender also doing business lending. We do amortizing loans, which can range from 1 to 5 years, although actually we haven't done any 1 or 2 year loans. Most of them are 3 to 5 and average length 4. We have, our average size loan is actually quite large relative to other lenders, so it's running at about $500,000, and we expect that to rise further to about $750,000 over the coming 12 months. We also have had most of our money coming onto our platform up to now from individuals, a lot of high net worths. About 70% of the money has come from high net worths to date, but we are just beginning to take on institutional money. We've had institutional money in our last few loans, and now we've got large amounts of institutional money looking to find its way onto the platform. Our average yield across our book so far is 9%, which reflects the fact that these are senior loans, and we have a first-ranking debenture over all of the assets of the company, so we will never sit behind another lender. So that's why the yields would be a bit lower. And so far, everybody seems pretty happy in terms of the returns they're getting, and we haven't had any defaults yet.
Thank you. I think many people have seen the recent Morgan Stanley report, which was very good, done in May, very comprehensive view of the global market. But, you know, it did, I think, generalize sort of about a small number of attractive markets for investors in marketplace lending. And really, I think of a continent of essentially 330 million people, really pointed to the UK as being, it implied, really the only market worth investing in. And so I'd really like our panelists to comment on the UK versus the rest of Europe, and that investment opportunity, is there one? And if there is one, what is it? And Stuart, why don't you kick off?
Okay. Well, I think the UK's main advantage is its regulatory system. There hasn't been any significant infighting, quite the opposite. All the key parties have been working together on it. So government wanted it to happen, Treasury supported it, the FCA decided to ignore it for 2 years, 3 years, 4 years, effectively, do nothing, and have now started to come in on a very proportionate basis. So we've had a lot of support. In other countries in Europe, it's been a bit of a nightmare for people. Backward steps, countries going backwards. France, for example, nearly shut down its main lender. Germany fighting it to the death. The banks dug in from a vested interest point of view. It's much different elsewhere, but UK, very straightforward, and for a secured lender like ourselves, a very strong property security system, very strong legal system. So it's a very safe place to lend on a secured basis.
Angus, I'm not sure you're as favorable about the regulation period. I mean, what is your view on this?
I think regulation is necessary, but I mean the point that Stuart makes is that regulation so far has been proportionate, but the question is so far, and I think we need to keep our eyes on the regulator and what the regulator is doing, and just be aware, because there is a tension, if you like, between government, who see this as a solution, and the regulator, who is there, despite them being a government body, of course, to prevent something. And there's a comment that somebody made earlier in the day about how equity-based crowdfunding has a tendency to lead the regulation, because that's where it perhaps crowdfunding originated, and that's where the biggest risk is perceived to be, and that creates a danger for us crowd lenders in that we all get, you know, they enact some piece of very broad legislation that catches us, and you know, to be extreme about it, potentially kills the business.
Now, Partel, you of course have a business which is not based in the UK. I assume that clearly, having started a business and grown one across markets, that you would consider that to be quite an attractive opportunity. So this is your opportunity to make your case.
So, yeah, I don't agree with the gentleman on my left. I don't think UK has the biggest opportunity. If you measure opportunity as sort of where you can really grow the business in the coming years, short term, yes, there's an existing market, there are institutional investors there's a regulator, it's in the media, etc. But that also sort of, you know, for people in the crowd who are looking at opportunities in Europe, it also means that you're late. You know, you're not going to get any preferred sort of partnerships anymore with Funding Circle, Assetz. They said they're fully funded. So, you know, for institutions and investors alike, I don't think that there's a great opportunity short term in the UK anymore. However, exactly for the same reasons or opposites, you know, what are the benefits of UK and what's different in sort of, let's say, continental Europe, there's a much bigger opportunity there. The markets are much more fragmented. I can primarily speak about consumer lending, so it might be different in an SME space, but there's very little competition in most of the markets. Every country is highly fragmented. You know, there's no alternatives to banks. There's banks and there's payday loans, sort of Wonga and Wonga alternatives, which is very far end of the subprime, very short-term loans, 100 euros, 1,000% APRs. And there's nothing really in between. There's nothing for the prime, sort of, let's say, lower levels of prime, near prime, and higher levels of subprime customers. So there's a huge opportunity. The banks have highly inefficient technical systems, all the big banks, Santander, BBVA, who've been on here, in reality, most of the origination processes don't work that well, which means there's a huge opportunity. There's a huge opportunity for non-bank lenders, and there's a huge opportunity for institutional investors, because in most of continental Europe, excluding maybe Germany and France, the yield or the premium or spread in the consumer lending space is something different than you can ever achieve in UK. So Finland, which is, let's say in GDP per capita terms, equivalent to UK, consumers are paying three times higher interest rates on personal loans from the banks. So if in UK, I think the average rate is around 7%, then in Finland it's 21 to 24% on unsecured personal loans from Finland, from banks. Why? Because there's two banks which control 80 to 90% of the market. And you see the same patterns elsewhere. And the real reason why we're sort of having this, let's say, periphery approach is that there's lack of competition, the yields are higher, and there's more that we can actually do for marketplace lending or non-bank lending to help the consumers than simply push down interest rates. We're opening up the credit markets, and that's sort of the big theme that we're playing on. Sort of a single European market that connects consumers throughout the Eurozone and makes it accessible as a sort of one-stop shop for the hedge funds in UK, the hedge funds in London, the hedge funds in New York, and sort of banks and private investors all across the world. So that is what we're building on. And for us, UK is not the target, as you understand. So we're focused only on Eurozone and sort of Eurozone countries.
Yeah, one anecdote about Finland, by the way, since Partel brought it up. I was in Finland about 3 months ago, and I was struck by how high the loan rates were for consumer lending. I was also struck by how negative the press is about consumer lending, peer-to-peer lending in Finland. And so I talked to one of the largest consumer lending platform in that market, domestic player, about what underlying issue here was causing the negative perception, because in most countries it's actually pretty positive, it's anti-bank. So why was Finland contrary? And why were the rates so high? I mean, I noticed the same thing. And where we really ended up, because they didn't have a clear but where we were sort of ended up is Finland is 75% Lutheran. And 75% of the country pays a church tax. And the press tone is a little bit a function of you live within your means. So borrowing as a consumer for what would be discretionary expenditure, not for education, not for something, is a little negative. And the platform suspected that people were actually willing to pay a premium to avoid the glare of the bank manager when they want to go in and ask for a loan for a vacation to Spain. And that actually not having to face so it was an anonymity premium, if you want to call it that. And I think it's whether it's right or wrong, certainly that was the hypothesis, because we haven't really studied that, but I actually am interested in studying that because we know who pays the church tax because it's all disclosed and we can map that against interest rates. But it is illustrative of Europe and these pockets in Europe that it's not monolithic. And if you understand how to exploit those and how to price those, I think it can be quite interesting. Now, Nicola, you have not moved into the continent. You've gone into the US. So why the US and not the continent? I mean, you can fly to Milan in 2 hours. It's a longer trip to New York.
Right, well, we haven't quite gone into the US yet, but we are looking at going into the US, and we're also looking at China. And actually, from a technical point of view, we could quite easily go into Europe because we have a platform which was built to be multi-currency and global. So we can deal with euros quite easily and so on. And we can actually also support 5 million lenders, individual lenders, on our current platform without expanding it. So it would be relatively easy for us to go into another territory, and Europe is very close. The only problem is, we're doing business lending. I've worked for a French bank and a German bank in the past, and I think that Europe generally is overbanked, and maybe the people running those banks aren't quite as good as they are in the UK at working out what's profitable and what isn't. And so I'm not sure there's the same gap that exists in Europe. And I think actually Asia, in many ways, as somebody was saying earlier, is a more interesting opportunity. We've also got a bit of a mess in terms of financial services in Europe where no one really knows what on earth's going on. It's very difficult doing business in places like Germany and France, never mind the smaller countries. And then the employment laws are also terrible. And if you employ the wrong person, it can cost an awful lot of money to get rid of them. So that puts me off going into Europe as well. You could, of course, just try and do the whole thing from London, but you really do need, when you're lending, you need to have people on the ground. In fact, in the UK, we're thinking about having people in the regions of the UK. So I wouldn't want to just sit in London and be a suitcase banker to other European countries, really. So I think Europe, for the time being, is not on our agenda. I definitely prefer to look at the US, which is the largest debt market in the world, and also I think China is very interesting.
Now, you brought up the issue of going cross-border, because, I mean, you know, Europe does have 330 million people. The largest country is Germany. It's got 80. The UK has about 60. So clearly, with businesses that have advantages from scale, going cross-border makes sense. Now, Stuart, it's not so easy. It's very easy in theory. And I know you've kind of what I would call safely gone cross-border into neighboring countries like Wales and Scotland, which, you know, is not exactly
and now Ireland.
Greece and Italy. You haven't gone to the Mediterranean yet. Do you want to talk about those challenges a little and the contradiction between kind of the, in theory, ability to passport and the practical reality of that?
Well, yeah, in theory, you could, with full permissions in London, you could theoretically passport over to most of the rest of Europe, but in practice, I think France and the UK are the worst offenders for not implementing European laws into their local laws, and there are conflicts. So it's not as easy as it seems at all. And then you've got language, then you've got security, or lack of it. Then you've got attitude, business attitude to repayment. The whole thing is very complex. Every single country is different and has a different financial system. Some of them have different financial products. Pagaday loans in Spain, which aren't quite the same as other types of loans in other parts of Europe. It's all very complicated. Plus the language. Brits aren't known for speaking lots of languages. And, you know, we might speak French. But do we speak French, Spanish, Italian? Whereas a lot of Europe does speak English. So I think the Europeans might find it easier to come to us. But Brits out into Europe, a bit more difficult.
Angus, you share that view?
Basically, yes. You know, it's an old joke about the English. If a Frenchman doesn't understand you the first time, you just say it again louder. That's a bit difficult with a piece of contract. You know, you just put it in capitals or something, but that just offends. So yes, I mean, it is a problem. Having said that, I don't think we can ignore the opportunity, and there is a drive towards harmonisation of legislation. It probably won't happen by 2019, but it will happen. It will happen at some stage, and you know, as an accounts receivable lender, market in the UK 300 billion or something, market in Europe more than £1 trillion. So it is a big opportunity, and we shouldn't forget the opportunity to go back to what you said before. That's on our doorstep.
Now, Partel, you've done it. You've actually gone cross-border. I'm curious as to whether it's cross-border with respect to inbound. So is it investors funding on your platform, or are you actually funding projects or businesses in other countries? Can you talk to that a little bit? Because those are different challenges.
So we're going cross-border on both sides. So on the border side, we accept loan applications from Spain, Finland, and Estonia. And we're regulated by, I think, 4 or 5 different authorities in Europe. So we're regulated by the FCA in UK, we're regulated by the Finnish regulator, Estonian regulator, Slovak regulator, and we're then sort of authorized by the SEC. So we've kind of learned to cope with the complexity, the different sort of regulations, different authorizations, and different credit behavior and attitude to payment behavior. On the investor side, it's the same. So, but it's much wider. On the investor side, we accept borrowers lenders from every country in Europe, plus 12 countries outside of Europe, including US and Canada, but with a sort of a covenant that we only accept accredited investors outside of Europe. In essence, it's not that really complex, to be fair, because the process you apply to a market is simply doing this process, n times, n being the number of markets you want to go into. The complexity sort of simply comes from the fact that although Europe in consumer lending is very harmonized, I think European consumer lending industry from a regulatory point of view is more harmonized than the US. So it's easier for me to go to Finland than probably, just making up places, someone from Nebraska to go to Texas. However, the regulators in those different countries don't always, let's say, act by the book. And they don't always know the European regulations. And there are conflicts between the European directives and how the guy who worked in the, Swedish Financial Services Authority remembers that law when he sort of, joined the authority. So there's a lot of this learning process, and working with the regulators. So it takes time, but eventually it's a sort of pretty standard process. The regulation that governs consumer credit is the same. There's a single payment system, so sending money from a country to another country takes the same amount of time than sending domestic payments. It only costs a few cents. There's a lot of these things that European Commission and European regulators, especially after the financial crisis, have put in place. So the Greek fiasco and all these sort of periphery issues that Europe has had has consolidated core Europe much stronger. So yes, maybe Greece will go, maybe it doesn't, who cares? But the central infrastructure that is in place for financial services, has grown stronger. And if you know how to leverage these and you sort of built into this infrastructure, then going, expanding into 6 countries at the time is not really a very, very big thing. So, I'd recommend you try it.
Stuart, you have a couple of thoughts, I think.
Yeah, I think you're right. I think it's different with consumer lending, simpler. But if you're doing secured business lending, it's very complicated. Very complicated. It's bad enough perfecting security in the UK in one of the best, most transparent property markets there is in the world. Doing that in other countries, dangerous to say the least.
Another area that I think there's some distinct difference between the European and the American markets, say, is the role of institutional investors on the funding side. And I think there are some probably different views on the panel. I mentioned this morning that, say, RateSetter, there's a number of platforms in the UK that I would say are more resistant to institutional funding on the platform relative to, say, a typical US platform. That's shifting a bit, but there still seems to be a tone there to some extent. Now, Nicola, you come out of the institutional money management world. What's your view? How are you trying to balance? I think you're basically focused on institutions. I mean, that's what really got you into the business. Is that correct?
Well, initially our lenders have been individuals, and now we're moving into the phase where institutions are beginning to lend on our platform because we've now got a history. And I think what will happen in the UK is very much what's happened here in the US, which is that it will become dominated on the lender side by institutions. But it's very interesting when I've spoken to UK pension funds, because they just all think it's all too small and they're not that interested in it at the moment. And what they've tended to do is to invest in publicly quoted vehicles, which are then investing in our space. And that's the easiest way for them to get exposure. So they're just treating it like a listed equity. And then they're using a vehicle to get exposure in a normal UK equity portfolio. So whether that will change, I'm sure it will over time. I think what we've got to demonstrate is that we can become a truly investable asset class for institutions. And that means it needs to be big enough Because when you talk to the large pension funds, they're just not going to be interested in investing 10 million. They want to invest 100 or 150 or 200 million. And leverage also is going to be important because different investors have different risk appetites. And for those that have the higher risk appetites, which tend to be, the large American players like Ares and Fortress and so on and so forth, they want leverage. So you're then going to have to create portfolios of seasoned loans, apply leverage to get the sorts of levels of return that they want, because the base return, I think, as we've understood, is lower in the UK than it is in the US. So if you're getting 9% as we are gross on our portfolio, and they want minimum 12 and preferably 15, you can only achieve that by applying leverage.
Now, Angus, when I look at your website, and I hear how you position your product with it, what is essentially a credit wrapper. As I understand it, you're really targeting an individual investor. You're targeting an investor that may be retirement or pre-retirement, so possibly I'm your target. And I'm looking for very secure, something from my pension fund, for example. I mean, am I right in that, or are you actually interested in institutional money?
We have a saying that everybody is part of the crowd, and most of what you just said was correct and does apply to us, but actually the first lenders we had across our platform were institutions. We started entirely the other way around to what Nicola has described, and I think we started, if you like, with the smaller institutions, those who were quite happy to work with us and lend just a few £100,000 a month over the platform to start off with, build their confidence in our credit analysis, in what we were doing generally. And as they have built their confidence, so we get to a stage where they're pledging automatically across the platform under some form of mandate. And on the back of those institutions, so we have brought in the individuals, starting, I suppose, really with the single family offices and high net worth individuals. So if you like, when we were specifying the platform, we had very much your view that we would start with those high net worth individuals, but in actual fact we started with institutions. Now we're seeing some of the larger institutions come along a little bit, as Nicola described, and wanting to lend larger amounts of money over the platform and put the leverage in and all that jazz. But we will stay with that mix of institutions and individuals lending on the same terms as well. That's very important to us. We won't be putting special terms in for institutions just to attract their larger amounts of money.
Nicola, you mentioned returns in sort of the US versus the European market. Partel, you're going after the accredited, or going to target the accredited US investor market. And so I assume you talk a little bit about why you're not going after institutional money instead. Frankly, it sounds simpler. But obviously there's a rationale here. And why US investors? Why accredited US investors?
So just to clarify, we're not going after only accredited investors. So since the beginning, or since the last couple of months, we've been working also with a number of US-based hedge funds. So they're in parallel, not exclusive. So the focus in general is on the US market, both, and hedge fund industry, as well as accredited investors. The reason is simple. Why US investors rather than European investors? There's sort of, let's say, two broad-speaking reasons. In Europe, you don't find, let's say, private investment houses that have sufficient amounts of capital. You have pension funds, you have private banks, you have family offices, you have wealth managers. All of them are very, very regulated. So wealth managers in Switzerland would require your product you have 30-day liquidity, right? So, even if you have a secondary market on the platform, it doesn't really count for liquidity. So you would have to have a listed security. And the sort of similar sort of reasons apply the rest of Europe as well. So it's very hard to actually package it to a European institution, and the sort of influx of institutional capital UK is predominantly US origin. So, guys who did it on Lending Club and Prosper now sort of on funding and funding circle, etc. So, in effect, we see that there's the types of investments we can offer and the types of sort of returns we can offer unlevered, so 18% unlevered net, is something that makes it sort of attractive to US-based investors, and also somewhat sort of might scare away European investors, because Europeans are very risk averse. So when, we've been operating on the retail market for a number of years, and what we found, for example, with German-based investors is that the higher the sort of net return, expected net return goes, the less demand you have. Because it sort of, first of all, it seems too good to be good, and it kind of is, maybe I'm doing something morally wrong. Sort of the same Lutherian sort of angle comes in. In US, we see a different sort of appetite. It's a sort of more risk-based, sort of more return-focused. There's a, let's say, much more liberal view on where sort of different assets can sort of price. It's very algorithmic, and then sort of it fits what we do. So we have a very sort of market-driven methodology, how we price loans, how we match these with sort of the assets in the industry, and how we've structured also our investment product. So we modeled it based on the ABS industry in US, and then we're trying to really sort of target the ABS industry here. So really, because this is where we believe the true, so there's a better fit with the culture and the investment culture and the markets, rather than in Europe.
Now, Stuart, I know that you're interested in bringing institutional money into the platform. And I think you face this challenge of talking to US investors about returns relative to, in terms of a European originated asset. Is it the same asset? Are we talking apples and apples here if the headline returns of a European loan may be lower? How do you counter that? How do you address that with investors?
Well, yeah, where do you start? First of all, the US money people are assuming is coming into the UK is mostly raised in London, on London-listed investment trusts. So it might be American names, but they're raising it in London. Then they're lending it on UK platforms. So P2PGI, the first investment trust, is a London-listed trust with an awful lot of, most of its money, I think, coming out of the UK. And then we've got the question of diversification of funding sources, the same issue banks have, trying to align the term requirements of lenders with the term requirements of borrowers, trying to align the need to have a diverse range of funding sources with the potential for the next recession in a year or two. So it's all about trying to get funding sources which have different risk appetites, which have different cycles. So certain institutional money will run for the hills quicker than retail money. So it's not something you can just abandon. You know, it sounds like we're walking away from retail money, quite the opposite. I think everything has its place. And it's about having a mix of those funding sources and being nimble.
Now, Nicola, you mentioned that you're looking at, from an origination perspective, conceivably putting people, the feet on the street in different regions of the UK. There was a lot of talk today about the growing collaboration of banks, particularly in the US. I mean, I think it's through the phase where the banks are saying, either we ignore it or we're not going to engage. There's very effective collaborations. Why would you not do that? Why would you not? The banks have the feet on the street. So why do you want to do your own thing?
Yes, so there is collaboration already going on. There are people who are have arrangements with banks where if they have a loan that they've rejected, they will pass the borrower across. And the government has encouraged the building of a new platform where that will happen automatically, so that all banks will actually have to pass the loans that they've rejected, which will then be input into this platform, and then all of the platforms will be there, and they will then try and match that borrower to the most suitable lenders. And that should start operating next year. It's been delayed by about 15 months, but hopefully next year it'll start operating. So that will be helpful. In terms of having feet on the ground, it's really about relationships. And somebody was saying earlier that speed is a very important factor here. One of the things that we can do is we can crunch all the numbers within 30 minutes and decide whether it's a loan that we want to make. Because we then take a first-ranking debenture over all the assets of the company, it then takes a few more days before we could actually, even if the money was just there and was coming from one institutional lender, it takes a few days to actually get the money out. It would probably take, a week to 10 days. Nonetheless, compared to a bank, that's really fast. But I think the thing is, because we're doing larger loans, we need to compete with the banks. We need to be there. We need to be in the regions. We need to be talking to the companies about their needs. And if we're just sitting in London and telling them to come and see us if they're there, that's not really good enough. So it's not just about speed, it's also about building relationships. Several people have also said today that they want to develop those relationships across other lending verticals, and that's something that we aspire to as well. So I think, just like the banks did over the years, they didn't just do one thing, they did multiple things. We are looking to provide other sources of finance for different things for businesses, not just a straight senior loan. And I think if we're going to do that again, we need to develop relationships over time, not just be an electronic lender.
Thanks. Okay, we're just about out of time. Are there any questions before we close off? No. Okay, everybody's getting thirsty, I suspect. So please, let's thank the panel.